Hello guys, so I am Jalaj and today I'll be we'll be saying why option buying is not a profitable idea as it seems like. So see what is a option buyer and who is a option seller. So option buyer is generally a person who actually pays a premium for buying the option. So a option can be considered as a person who is hedging his position or taking a speculative position for against underlying. So here underlying can be stock or commodity. So as option buy options exist in both stocks, commodities, and currencies also. So he is particularly betting against the one direction of the stock. So for example, we have a call option. So call option buyer is a betting against that stock will go up, then only he will get profit. Or we have a put option buyer. So a put option buyer is betting against a downside of the stock. So if a stock falls uh, below the strike price, then the put option buyer will get the profit. Okay, so there is the option seller also. The option seller is also known as the option writer. So he is the person who sells the option to the option buyer. So option seller will get limited amount of premium. So premium is the amount which the option buyer pays to a option seller. So he is like a insurance seller which is giving a insurance to the option buyer. So for example, if a stock falls below a particular level, then the option seller will pay to the option buyer. So the maximum profit for the option seller is the option premium which he's getting from the option buyer. Okay. So here is some interesting fact which I want to share. I think most of you will be already knowing what is the at the money option, in the money option, and out the money of the. So at the so out of the money is options are those which are above the strike price for a call option. Okay, we'll see example of this also just a minute, and we'll see that like for the out of the money option the premium erosion is significant as considered as like the at the money option. So it is the time value. So even if like your stock or commodity or anything which doesn't move, the your premium will erode. So erosion means like premium will decrease as the time passes. Okay, so here are some limitation for the option buyers. So as an option buyer, uh, you will be like betting against the time. So if you are paying some premium and your stock or underlying anything doesn't move in your direction in your favor. So for example, like for the call option, it should move in upward direction. So if your stock doesn't move in upward direction, your premium will decrease. Okay, and the main thing is that for option buyer there is always a particular problem like when to exit the contract. So options are contracts like time bound contracts. So a option buyer never knows like when to exit a contract, because like if you are paying a premium of 5 rupees, then uh, it can increase to 10 rupees also, and maybe 20 also, maybe 100 also. So for option buy you never know the when to exit from the option contract. Okay, so here is example of like SBI. As like we all are knowing that financials are in big trouble and like they are falling continuously in the last 1.5 month. Okay, they have hardly recovered anything from their significant lows and still they are falling. So as an option buyer, like I want to bet against like this position. I want to bet like the stock will go down, and I will like if for example in the April session, I will think that like the stock is around trading around 200, like it is trading around 190. I am betting that stock will go down to around 150 levels. So I buy out of money option around 150 levels. So see, like your stock falls for 1 day, 2 day, so it falls and then again it rises. So for option buyer, like if the stock is moving upward, downward, so this thing will only decrease the premium. Okay, now see the example of like here like I in this example like I've taken 170p in the appreciation. So for example, like you have taken 170p. Okay, and see this chart is like if you have entered anywhere here you have entered like at the 7.5, 5. Okay, and you didn't exit it around 11 or 12 points. So see, like your premium eroded to like around 2 or 3 levels. So that is like problem with the option as an option buyer. Option buyer, you never know like where to exit, and you cannot maximize. There is nothing like maximization of the profit in for the option buyer. So now we'll see like what are the daily returns. So here like I am considering the daily returns for SBI. Why? Because for an option buyer, always there should be a significant movement in a stock. So I've taken an example of the SBI here. So here like I want to tell like for option buyer, it is very important that the stock moves more than 2 or 3%. Why I'm telling it 2-3%, because option buyer will always buy out of money options. Out of money is the cheapest. So the he will bet like around 5,000 to 10,000, something like that. So for option buyer, they generally do have a limited capital, and they always buy out of money options. So if you see this if you see this trend of like for last 1 year, so you will see that maximum movement happened in like minus 3 to plus 3% only. Like it's less than 5%. So it is very important like when you are buying the option, even if like you miss the 1 day, if you miss the 1 day, then your option premium will decrease, because like you have to bet against a lot of things. So now we'll see like what are the things which option buyer need to see. So as option buyer, we need to check at least 4 to 8% movement in underlying, because then only like you will get some profit, whether you are buying a call option or you are buying a put option. So it is very important like you should know that you are able to grab 4 to 8% in the underlying to make a significant amount of profit. Okay, so for option buyer, like you should know how to calculate the stock move in a day, which is very difficult, because in the market, if you're predicting something, like it is always like, and there a lot of uncertainty is there. So and the other thing is that option buying in high premium. So currently, like we all know that due to COVID-19, market are significantly moving upward and downward direction, and like volatility index is already like around 40. So in any circumstances, like if your volatility index goes below 14, like volatility will decrease, then it is very harmful, it is very disastrous for the option buyer, because premiums are directly related to VIX. So our option buyer should know where to entry, where to exit, because you should follow the stop loss. If you don't follow the stop loss, your premium is already gone. You cannot like save your capital. Okay, and I've already told like option premium, sorry, you have to calculate the direction of the stock or commodity, whatever you're trading. And you cannot take a heavy position against like the when the results during the result season, or the when some important corporate announcement is there, because in such circumstances like premium is already heavy, and you should never try to do that. Okay, now we'll see like live example where like how I am giving the example of this. So for example, let's take example of SBI, which we've already discussed. Okay, let's see. This is the example of SBI, and as we think, no, like SBI is already falling from a lot of days. So currently, like it has broken this important support. Even if you see, like it is taking some support here, but it has broken this major support around which was around 174 levels. So if you take position like here, if you take position on 5th of May, and like if you think that SBI will go down, and as it has broken all supports, SBI 150, like you bought SBI 150C. So here on the 5th, you bought SBI 150p, which was around trading was around six levels. So see, like on the next day, it shoot up to seven odd levels, and then again it's constantly going down. So even if like SBI has broken its important support, the premium is going down because like the movement is not in vertical direction, in the same direction. See the stock is it went down and went again up, it again went down, again up. So the premium is like eroding. Premium erosion is there just because like stock is moving down and up. And whereas like for an option seller, I would say like for an option seller, if you think that the stock may not perform much, so you can consider selling option like a SBI 200 call option. See, on 5th of like May, you took the option. So like you took around 4. See, after that, like you have at least earned 2 point premium. So this is like important thing which you can understand as an option buyer. So like option buyer is not the person who always earn. He's the person who always lose. So again like here in the case of Coal India, so Coal India is constantly going down, and we can see like the stock is continuously underperforming the Nifty. So under some circumstances, like see here, it has broken important support. See, and again like if you see this is this some support. So again it is broken this support, and again like here it is not performing as like it like 150 is the resistance, so it is continuously falling from there. Okay. So under some circumstances, like if you're considering buying a put option, so you may or may not get good profit. Okay, there are the major chances like you might lose. So it is better to sell a call option when the stock is in bearish phase. Okay, now we will see like what are the premium required for like not premium, what are the margin requirement. So you can go on this Zerodha margin calculator. So I mostly use Zerodha for most of my trades. So for like SBI, if you consider selling 200 call option, the margin requirement is around 1.2 lakhs, and you will get a premium of around 5500. So if you are buying a call option, buying a call option or like buying a put option, there are very low probability that you will get the money, like you will make the money. But if you are selling the call option or selling any option which is in your favor, in your direction, so there are major chances like you will get some money, you will make some money. Okay. And like for SBI, it is margin requirement is quite high, but for the Coal India it is like just half of this. So for the Coal India, if you think that Coal India will not perform, you can see the like 150 call option, and margin requirement is around 58,000, and premium receivable is around 3,000. So in these circumstances, like you will make some money. At least you will not lose, because in the stock market it is very important to save the capital than to earn the capital. Okay, I hope like you got a good idea from this video, and you can check out my this article which I've already written in for the option, like when to buy. So when why a option is buying is not a profitable idea. Okay, I will drop the link in the description. Okay, so that's all for now. Thank you for listening. Bye bye.